With a changing market, investing success requires a clear strategy and a track record of performance. If you're serious about building a property portfolio, you need to speak with Lachlan Vidler and his team at Atlas Property Group. As a national finalist for 2022 Buyer's Agent of the Year, Lachlan and his team are ready to build and scale your portfolio in any market. Whether it's financial freedom or a more secure future, Atlas Property Group is here to guide and support your personalised journey. Visit atlaspropertygroup.com.au to book in your discovery call absolutely free of charge.
This is a Momentum Media production.
Property Finance Uncut, the must-listen podcast for anyone with a mortgage. Find out the truth about what Australia's lenders are up to and how to make sure you're in the best possible position when it comes to your property finance.
I'll get everyone. Phil Tarrant here. I'm the host of Property Finance Uncut. It's a new podcast as all Australians with a mortgage try and navigate this interest rate environment we're in right now. Cast right across the Momentum Media network. So you may be a lawyer, a defence professional, real estate agent, accountant, a wealth professional, and property investors right across the Momentum network of podcasts. Brand new show to help you navigate this rising rate environment. Importantly, what you do about it. And for most of us, mortgage is the biggest financial commitment we'll ever have. And you may not know, and if you don't know, you've been hiding under a rock, that interest rates are on the way up. And if you have a mortgage right now and it's a variable rate mortgage, it's going up and it's going up rapidly. And I'd like to think probably if you listen to smart people informed in the economy, it's going to keep going up. Now, we're recording this on the day of the interest rate announcement. For those of you who don't know, every single Tuesday, first Tuesday of every month, the RBA get together and work out what they're going to do with interest rates. And today it's gone up another 50 basis points. And indications say that it's going to keep going up towards the end of the year to a point where it will plateau out and hopefully start coming down. But this is not a podcast around the machinations of interest rates environments. It's a podcast around what do you do about it if you do hold a mortgage. A little bit outside my pay grade, but I've got someone in the studio joining me who knows about these things. Paul Glossop, he's the CEO of Finni Mortgages. That's finni.com.au. Him and his team are working with Aussie investors and Aussie homeowners to help them recalibrate their mortgages and making sure that they're paying the right rates and they've got the most appropriate mortgage for their needs, particularly as rates go north. Paul, how are you going? You well?
Well, mate. Well, yeah, and mate, you I think exclusively noted there that today is the day that we've seen interest rates increase again, and the word is refinance. That is the word for the rest of this year, and if people aren't, I guess, honing that into their thought process, if they own a mortgage or own a property and hold a mortgage against that property, refinance is where you are going to ensure that you're maximising your cash flow, minimising your payments, regardless whether it's an owner-occupier or an investment property.
Throughout 2022, we've already seen a huge ebb and flow in the Australian housing market. Property prices increased earlier in the year, but the rate hikes have slowed down price growth over the last few months. Even so, we've seen more new listings hitting the market than we've experienced in recent years. Plus, with many property owners having accrued a significant increase in equity, the market is hot for investors looking to snap up another property that may have reduced in price. To help you find these properties, the team at Pure Property Investment have done all the legwork to identify the top 30 suburbs that have not only shown growth throughout this year, but are also poised for strong capital growth over the next few years. Grab your free top 30 guide to property investment guide today at www.purepropertyinvestment.com.
And this is important. So if you have a mortgage, this needs to be on your radar. Absolutely. Because it's costing you, it will be costing you money. There will be some impact. Now, if you make so much money, you don't notice it. Well, that's fair enough. You're probably only a fraction of Australians that have that. Most Aussies with a mortgage I know, this is front and center, and it's a lot of the topics of conversation around the dinner table and at dinner parties. Now, Paul, this is not about a podcast where you should be buying property. It's not a podcast how to buy property. This is about how do you manage your mortgage more effectively for all Australians, irrespective of what you do and how you do it. Now, some people's mortgages are pretty low, a couple $100,000, 50 grand. Some people's mortgages are pretty high, millions and millions of dollars. When you look at the impact and ramifications of a 50 basis points increase, for example, on $1 million, it's costing you a few more bucks each year to hold property.
Mate, absolutely. And I think this is the key now is the reality is that what I just said a second ago is about the finance and refinance component of what people should be considering here is the fact of the matter is with this recent increase, we're now seeing that we've got a basis of 2.35%. And the reality is that majority now, and this is some interesting information that I think will impact almost all of the listeners who hold a mortgage on this podcast, is the reality is that the peak of fixed interest and fixed mortgages was July last year. And what that means is that the vast majority, and it was about 50% of all mortgages mid last year, mid 2021, were fixed. And the majority of those fixed loans were either 1 or 2 years. So what does that mean? That means that you've got a whole host of people right now who are seeing their fixed rates in the 2s, and they're now coming off if they've held them for a year or if they've got a 1 year fixed rate. And the difference right now is about 40% difference on an increase on what your variable rate will be costing you right now if you fixed this time last year or as of July last year. And to your point, mate, if you're talking a $1 million loan and you fixed it at let's say at 2.5%, and that's all of a sudden now 4.5% or potentially more, because a lot of those variable rates roll off to a much higher position, you're talking 20, 30 grand a year difference. And the differences of where banks are now positioning their finance for new clients and new customers is literally in the vicinity of 0.25 to 0.5% difference for an existing customer to a new customer. Now, that's where it all needs to sink in for people. And the reason why we're reiterating this word refinance, because it is absolutely paramount for people to think, well, if your bank is not going to sharpen the pencil now that you've rolled off a fixed rate that was sharp only 12 months ago or even further, then you potentially are getting stung to the tune of the best part of 0.25 to 0.5%. And that is literally thousands and thousands of dollars a year.
Yeah, I'm conscious that we're using a lot of finance terms here, Paul, and a lot of the listeners might not be too au fait with it because they got a home loan way back when and it's just sat there and haven't thought too much about it because interest rates have been so low, record low levels, went down to 0.1%. So we're in a very different environment right now. So this needs to be on your radar. Now, we're using different terms. We're talking about fixed rates, variable rates. We're talking about refinance. We're talking about this, what is deemed the fixed rate cliff. Now, what this is that if you took on, as Paul said, a fixed rate, as in it was the same amount you were paying every single month in repayments because the rate was fixed, at a point in time, the period of that fixed rate comes off and you go to a variable rate. And it's typically a lot higher, will be a lot higher in this market. Now, give some sense for that. I'm happy to give you an example. So my example for a property that I own, I bought a property, I had a few zeros in it. Now I took a split loan. So half of it was fixed and half of it was variable. At the point in time origination last year, the fixed rate, Paul, was 2.59% and the variable rate was 2.89%. Now I'm still paying the fixed rate component at 2.59%, and that will continue. I think it was a 2-year term. So that will continue for another year and a half or so. The variable rate, which started at 2.89, is tapping on the door of 5% right now. And that's increased my repayments considerably. Now, if you just have a fixed rate product and it's coming off, you will be refinanced by the bank into a new loan at a variable rate or a new fixed rate at considerably more than what you're paying or have been paying right now. And if that concerns you, you should get onto it straight away. We spoke about refinance. We'll get into that in a moment. But there are many things you can do about it. The first thing is being aware of it. When does your rate come off? What are you paying right now? How much is it costing you right now? What the difference is going to be? And can you actually wear that difference? Or do you need to take more drastic action, Paul? And one of them may be refinancing.
You're exactly right, mate. And I love your example because it's actually a very common scenario where, especially owner-occupiers, if you've bought a property, you're typically going to take on a fixed component and then a variable component. If you have a bit of extra cash you want to put in the offset, obviously that parks against the variable. And I don't want to get too technical on the machinations of that, but to your point of what those two different loans are costing you, one's costing you 2.5 and change percent, the other one's now close to 5%, basically double what the fixed rate was only 12 months ago. This is extremely common. And where I think this is what the listeners need to consider is that if rates increase or as and when they've increased, the position that a lot of people take is that's just the way it is. And look, yes, absolutely. The price of money is more expensive. The price of getting a loan now versus a year ago is more expensive. However, the biggest difference that we're seeing now in the money markets is that when we went from where we were 12 months ago, 18 months ago, 24 months ago, the property market was booming. The banks didn't have a problem finding new customers or even refinancing their existing customers. But what's happening now is that actual loan transactions are down about 10%. So what does that mean? Well, it means that the banks have got 10% less loans that are coming to them to write. So what does that mean? It's a supply and demand game. They're getting more aggressive and they are sharpening the pencil, particularly for new clients. So in your position, Phil, is the exact scenario where I would recommend, if your loan was coming off hypothetically in the next 3, 4, 5 months, you mentioned be prepared, is that you don't wait for the point in time where your fixed rate comes off. Because the best scenarios that you can work yourself into, and the way that our brokerage team would typically like to work with that scenario, is saying, get in touch with us 3, 4, 5, 6 months out from that fixed rate coming off, because what that does is it allows us to then position you into what the best options will be. And I can invariably, unequivocally say that you're always going to find that as a new customer going to a separate bank, you're probably going to be talking the difference of 0.5%. And if your loan, again, is $1 million, you're talking $5,000, $7,000, $10,000 a year difference on $1 million loan, just in that example as it stands.
And I can't imagine anyone who wouldn't want $7,000 more in their back pocket every year. That's a nice family holiday somewhere internationally, right? It's a big chunk of change. And I don't want to be alarmist about this. I just want to be measured and considered for all of our listeners out there in all the different markets that Momentum Media operates within. It's about knowing what is looking ahead, about knowing what your personal circumstances are right now and working out whether or not you want to be saving a few bucks on your mortgage. And I imagine every single person wants to do that. Now, there's a couple of different ways you do it. One is refinance. The other way to do it, I've done it myself before, and I've spent hours and hours online to my current bank saying, hey, I'm an important customer. If you want to keep me, you need to keep my interest rates at a more favorable rate. Most of the time, they'll ratchet it up, and everyone's been getting the post, still the paper post with the banks informing you that your mortgage has gone up another 50 basis points, and another 50 basis points, another 50 basis points. It's incumbent on them to tell you what your interest rate is. A lot of people just throw their bank statements out and don't even look at it. So jump onto your internet banking right now and have a look at what you're paying. Go back to February of this year and work out what you're paying then if you're on variable rate loans. You'll see very, very quickly what the difference in the cost to hold your mortgage is now. So get onto your banks and say, if you want to keep me, keep my rates sharp. If they don't want to keep you by moving those rates, it's time to start thinking about a new lender or a new bank and a new product and the right product. Now, this is where mortgage brokers come in. And for those of you who are unaware, mortgage brokers now write over some months, but around 70% of all mortgages in Australia. So that means 7 in 10 Aussies are now turning to their mortgage broker in order to sort their finance out. Now, refinancing your loan is going to take you time, energy, and effort. But if you want to start saving money in your back pocket by refinancing a loan, you've got to put it in a hard graft. Now, this is where a mortgage broker comes in. Paul, you and your team at Finni Mortgages, finni.com.au, you've been doing this for years. How hard is it to get your mortgage broker acting for you to make sure that you've got the best rate and the best product possible?
Well, it's mate, you've got all the data at Momentum Intelligence on how hard it is, but the reality from what we see on a day-to-day basis is that you're always going to have the bell curve. And I think if you have not had contact from your broker over the last 3, 4, 5 months during this increase of actual interest rates and the actual variability of what people are being charged, then that's probably your best indication that you're probably not getting the service you need. The simple answer to the question, however, is that it's actually really straightforward for us. I mean, the beauty about our position of having about 45, 46 different lenders on our panel is that not only are we looking at what you're able to probably sharpen the pencil on if you did stay with the same lender. So in your circumstances, you can call up your bank, but us as your brokerage team will be able to reprice your loan with the same bank anyway. But it's at the same time, we say, okay, look, we've spoken to your bank and we know that they were probably not giving you what a new customer would be achieving on an interest rate aspect. But in the same token, we've been able to get that interest rate down to X. And then what we'd likely want to do is provide you with 2 separate examples of probably what the best rates for exactly the same loan structure would be if we refinance to another bank. I could probably bet my bottom dollar that 19 times out of 20, those other 2 options would be better. But there's obviously going to be a hassle factor that goes in that. So we're going to weigh it up to say, is it worth going through the hassle for a small wedge? At the moment in the market, that small wedge is not the case. It's not like, I mean, this goes back to, we're just at the start of this first interest rate cycle increase in 10 years. So banks have been quite lackadaisical. So they're sitting on their heels a little bit. And I don't think they realise what tidal wave's coming, in the sense that refinancing, going to other banks who are a lot more hungry, a lot more aggressive, is going to mean for the consumer. So I guess to that point, mate, it's very simple. But I agree with you that for us, it's not always, hey, refinance to another lender. It's, hey, let us work hard to figure out what we can get done with your existing lender, and let's provide a couple of different solutions to say, hey, if that's not going to float your boat and we know that these other couple of solutions here are far better off, then let's go through the process of grabbing those documents and going through the application, because we are seeing the difference right now from a refinance perspective is literally thousands of dollars. And it's the greatest gap that we've seen in the best part of a decade in the money markets as far as what new customers are earning versus established customers are being charged on their mortgage rates.
Have you considered adding Perth property to your portfolio? Momentum Wealth has experts on the ground to help you find the best opportunities in WA. They'll take care of everything from shortlisting and inspecting properties right through to negotiating the best deal on your behalf. And when it comes to managing your property, they have experts for that too. Contact their award-winning team today at momentumwealth.com.au and get your advantage in Perth's property market.
Now, I'm going to give everyone probably the worst kept secret in times of banking. Banks love lending money. That's what they do. That's how they make their money. And I have it on good account that for a lot of the major banks, most of the value of their bank balance sheets sit inside of mortgages, and mortgage brokers are a huge driver and originator of that business. So they need to be friends with mortgage brokers. Mortgage brokers are helping to recommend and advise Australian borrowers around debt finance. Now, no doubt our very good friends at the regulatory body who do a great work in policing Australian mortgage are listening to this, and we need to be very considered about our commentary, Paul, because we're just a couple of guys having a chat around mortgages and some of the things that you can do in order to help minimise the financial impact or stress or everything connected with it. But I reckon every single borrower wants to pay as little as they can to service the debt that they have. So that's okay, and we're allowed to talk about that sort of stuff. And I want to get into some scenarios. Maybe if you give me some numbers and stuff. Again, this is just really, really super general stuff. If you want to have a chat with a mortgage broker, finni.com.au, they can get in touch with you there, no doubt. You can have a more informed conversation around their specific needs, and that's what's important. Everything is different for everyone. There is literally hundreds, if not thousands, of products out there to suit different borrower profiles, where they are in their journey, how much debt they have. It's like a fingerprint, right? Everyone is absolutely unique. So a couple of little examples, Paul. What sort of rates are the banks offering at the moment around sort of fixed rate products?
Yeah, look, if I'm looking at owner-occ, so let's say owner-occ will work on owner-occupier 80% LVR or better. So essentially you've got less than an 80% debt on the value of the property. For an owner-occupier, even with today's increase, you should be achieving some of the better rates for first-tier lenders, non-major four bank lenders. I will elicit that. They are tracking around that 4.2 to 4.3% for owner-occupiers with an LVR of 80% or better. So to your example there, Phil, on that variable rate, that in itself that you said you're paying on that split portion of that one loan, that's a massive difference right there. So that in itself is probably where I'd expect that 4.2, 4.3% if you've got an 80% loan-to-value ratio.
Sorry, is that variable fixed rate, Paul?
That's a variable owner-occupier rate.
Yeah, okay.
Well, I was going to say, if we look at that into a fixed rate scenario, the reality is fixed rates are actually slightly higher. So it's a little bit converse of what you were talking about this time last year. Is that fixed rates are probably for a 12-month fixed rate, you're talking more so around that 4.5, 4.6. But when you push out to 2 and 3 years, it's actually dropping again. So it's sort of hovering in that round about that 4.4 to 4.5%. 2-year fixed rates we're able to achieve at the moment with an 80% LVR or better, which gives you a little bit of an indication as to where the money markets are probably pricing in interest rates at the moment. But if I move away from the owner-occupier, and that for me in itself is where the majority of the listeners are going to be saying, hey, look, if you don't have that 4.2, 4.3% right now factoring in today's interest rate increase, not where it was a month ago, but after today's increase, then that's an opportunity enough to say, do your math on what the difference is of what you're paying and what you should be paying, and get in touch with us because we can talk about where those opportunities would lie. But if you're in the investment space and essentially you're holding that same scenario, 80% LVR or better on an investment variable loan, we're talking for P&I, you're talking around, again, that 4.5, 4.6% position for fixed P&I in that position for 12 months. But if you're interest only, you're talking around about that 4.6%. So it's actually about the same for a variable interest only investment loan for 80% LVR or better. You're actually tracking pretty good. So again, if you're in that position that you're in there, Phil, where you're pretty close to 5, if not a touch over 5, and you're an investor, obviously as an investor, cash flow is everything in that game. If you're talking holding $1 million in debt and you've got 0.5% difference in what you should be paying, that's an extra $5,000 a year net that you're losing for the sake of essentially just being lazy. And probably just going back to one of your points a second ago, Phil, is that banks love lending money. I think I could add to that. Banks love even more people that have lent money in the past and are lazy. Because
banks love lazy borrowers. Banks absolutely love lazy borrowers. It's priced into their business plans.
That is it, and that is it. And don't. I urge everyone that if you can take one thing away from this, do not be that lazy borrower statistic. Buck the trend and get on the phone to your bank or get on the phone to us at finny.com.au and say, hey, here's what I'm paying. What should I be paying? Because I'm sick of getting turned over by the banks and put it into the too hard basket and put onto an hour wait call only to be told, hey, hang on a second, we'll have to put a request in and we'll get back to you within 5 business days and never get a call back.
And I'll give you another big tip, right? So banks love lending money. You would think they hate doing it, right? Because they make it so hard to get it. But banks love lending money. They love lending new money. They like to keep the borrowers they can't have. So if you call up a bank and say, I'd like a new loan, guess what? You're going to get put straight through to someone and they're going to be really helpful to make sure they can get you into a home loan as quickly as possible.
Yep.
If you call up as an existing borrower, they're going to make it very difficult to get a hold of someone out. And the banks, you can send me the hate mail as well. You know how it all works. We're good friends with the banks right across Australia. But expect, if you're down this pathway, because guess what, Paul? There's a lot of people who aren't being the lazy borrower and they're being proactive and they're calling up their banks right now saying, can you help me out with this? That means phone lines are very busy. Wait times are really long. So strap yourself in because you're going to have a certain degree of patience to navigate the bureaucracy of a bank call center to try and get a sharper rate. So my advice and what I'm doing right now personally is getting my mortgage broker working for me, repricing my mortgages and making sure I've got the right mortgage for me. And again, I'm absolutely unique. You spoke about some rates there, Paul. They're just really, really loose examples around it. There's going to be different rates for different people depending what they are. Now, a couple of terms you use, LVR means loan to value ratio. So it's the size of the debt versus the size of the value of the property. So $1 million property with $800,000 of debt is at 80% LVR. So that means 20% is pumped in by the borrower. The bank owns 80% of it. You pay that debt down over time. Principal and interest. Interest only is you only pay off the interest component of the home loan. You don't pay down the principal. The principal being that absolute amount. You start at 800 and every month you'll be paying that principal down and that offsets the interest rate you pay. So there's a whole bunch of these terms and stuff. If you want more information around it, smartpropertyinvestment.com.au is where you can go and you can find out all of those terms so you're more informed. But Paul, it sounds like you got to speak to your mortgage broker. How do you track down Finni?
Mate, pretty simple. Finny.com.au, finni.com.au. Our team are there literally 24/7 to take these calls because not only is it the owner-occupiers or the investors, we also work with accountants in the self-managed super fund space, investors who are bought within their self-managed super fund. I can probably say confidently that space in itself is probably where there's the biggest discrepancy of what people are getting charged in their variable rates versus what they should be. You're talking in the vicinity of 1 to 1.5% difference in some of the rates we're seeing because people are on legacy rates of what their lenders spent or cost them only a year or two ago. And unfortunately, people just get lazy. So we're seeing that in some cases, we're saving people over 1% on their mortgage just by a simple refinance. And by the virtue of SMSF purchases, they're typically low LVRs, so they're very very simple loans to refinance to another lender as well, because a lot of lenders want to take those types of properties on their books.
Key philosophy, don't be the lazy borrower. Second thing, get yourself a calculator, look through your bank statements and work out what you're paying today versus what you were paying 5 months ago. And I think every single person will go, they'll have an uh-oh moment and work out they'd rather that money being in their back pocket rather than the pocket of someone else. So there is ways you can mitigate this. Speak to your mortgage broker. Paul Glossop, CEO of Finny.com.au. Go and find these guys that can help you out. I hope you enjoyed that, everyone. That's Property Finance Uncut. We're here to help right across the Momentum Network understand, navigate this rising rate environment. This is at the pointy end right now, and it's going to be like this for quite some time. So keep connected, keep informed, educate yourself, be responsible, take responsibility, and expect to do a bit of a work around it if you want to try and save a few bucks off your mortgage. We'll see you again next time. Until then, bye-bye.
The information featured in this podcast is general in nature and does not take into consideration your financial situation or individual needs and should not be relied upon. Before making any investment, insurance, tax, property or financial planning decision, you should consult a licensed professional who can advise whether your decision is appropriate for you. Guests appearing on this podcast may have a commercial relationship with the companies mentioned.
Would you like the latest news and insights in HR, leadership and people management? HR Leader has you covered. Subscribe at hrleader.com.au.